There's something stirring. Investment market data suggests prime northern commercial property has been having a tolerably good winter. Could this be the consequence of northern property's secret weapon, the so-called illiquidity premium? I'm David Tame, analysis editor at Place North. In today's Place podcast, we'll explore the red-hot attractions of property that's relatively hard to sell, why dead cats are bouncing over Doncaster, and how local pension funds are pumping up the affordable housing spend. Trade wars, real wars, fragile growth, sticky inflation, huge confidence-denting public spending cuts coming in March, and the risk of an asteroid dive-bombing the planet in 7 years' time. Happy days, eh? And yet at the same time, investment in prime northern real estate is growing. UK investment volumes topped 50 billion in 2024, according to BNP Paribas Real Estate. That's up 23% on the previous year. And the data from the North's big cities shows a small but genuine pickup in the speed of transactions at the end of last year. What's going on? The answer: welcome to the world of the illiquidity premium. According to the latest update from BNP Paribas Real Estate, UK investment in commercial property has been having its best year since 2021. The highlights include a 13% hike in industrial and logistics spending and continued interest in residential property. London did well in all sectors. Leeds and Manchester's office markets, like all office markets generally, have been having a tricky time. Data shared by CoStar suggests that 2024 was moderately dire, with total sales of 152 million in Leeds and 196 million in Manchester, meaning they scored, respectively, 33% and 46% of their 5-year average. This is a poor showing. What's interesting, however, is that it's a poor showing that's getting a little bit less poor. Things are getting better. Fourth quarter showed sales across the big 6 regional cities that exceeded the second and third quarter totals combined. And that puts things back into 2022-ish territory. You may not think of that as a vintage year, but it was okay, actually. There's still a long way to climb back to the top of the market in 2021, but it's all looking fairly hopeful. As if to prove the point, Tuesday this week saw Investec Realis and their partners XLB buy the 47,000 square foot Citygate office in Manchester for something like £14 million. The block is 90% occupied in a market with limited development and potentially rising rents. It's what Investec called a highly favourable entry point for UK offices. Now, behind this sits the illiquidity premium. Illiquidity, not being able to sell things quickly, is supposed to be a big problem, but for some investors, at some times, it's a massive blessing in disguise. Illiquidity premium chat can get very technical, but the gist is pretty straightforward. If you have deep pockets and you like to mix and match your portfolio and you take a long-term outlook, the relative cheapness of assets that are relatively hard to offload provides you with a real earning opportunity. When the gap between the liquid and the illiquid gets wider, because either one or the other has gone off the boil, the opportunity is that much more appealing. And it's appealing because you head into private markets, private debt, and property. They're the big targets. The gap between the liquid and the illiquidity premium, has been getting wider in real estate since late 2023, according to Aviva, who've published a lot of very interesting and nuanced stuff on all of this. Now, as it happens, all the signs are that the illiquidity premium is a big turn-on for investors in February 2025. And Aviva, again, have all the data. They say there's a pretty substantial investor pivot to private markets, with more than half of institutional investors expected to increase their allocations over the next 2 years, 2/3 of them expecting private markets to outperform public. It's an increasingly important reason for allocating assets over the next few years, Aviva said. Now, whilst the office market is a slow burn responder to the illiquidity premium, big sheds are moving a lot faster. The latest research from Newmark's Q4 UK Prime Logistics report shows that build-to-suit activity by retailers and demand for data centres rose by 15% in the final quarter of last year. Overall demand, including standing stock, was up 6%. Investment is growing to a shade under 8 billion, which is up on 2023, but by no means a record breaker. The trend, however, is clear. Locally, not so much perhaps. Take-up was a bit meh in both the northwest and in Yorkshire and the northeast in the fourth quarter. In the northwest, take-up was down 79%. And in the northeast and Yorkshire, it was down 54%. That sounds awful, but the only way is up from a position like that, and that's the kind of calculation that US giant Channel Crow Company has made, securing permission for 480,000 square foot in Hayward, and M7 Real Estate made a similar calculation, buying into the evergreen multi-let estate scene at the Broadheath Network Centre in Greater Manchester. They paid about 47 million. In a deal with Networks-based developments. Now, the money behind that was Australian mega investor Oxford Properties, and that's a name to keep in mind. The thing about illiquidity premiums in the real estate sector is that they tend to be strongly correlated to the bottom of the market cycle. The premium gets big and attractive when capital values fall and dwindles when they grow. The vogue for illiquidity premiums can mean investors are hunkering down, preparing to weather the tough times ahead. Or it can mean they're preparing for green shoots to start emerging. Or, most confusing of it all, it could be both. And now your regular rundown of what's going up and what's heading the other way in the Place North elevator. Doors closing, going up. Greater Manchester Pension Fund, a monster among defined benefit pension schemes, has invested 100 million in a legal and general fund to deliver much needed affordable homes across the northwest of England. The new regional vehicle is a structured extension to Legal and General's flagship affordable housing fund, launched in July 2024 to develop high quality, sustainable affordable housing all over the place. It is tailored specifically for the pension scheme's benefit, and would also fit Merseyside and West Yorkshire's local government pension schemes too. Just last month, the L&G fund mopped up another 100 million from London CIV, which is the investment pool for the London local government pension schemes. Third-party capital is still a novelty in this sector, but the scale of investment is growing. That pension funds see this as a safe and desirable destination for the long term is sure to result in more development faster. L&G has £1 billion invested in affordable housing and over 8,000 homes in operation or development to date. But pension funds aren't charities. They have to make good commercial returns, and it'll be interesting to see how far the social objectives of this investment mesh with the hard, cold fiduciary duties of the trustees. Hark, what's that noise? That thuddy, furry noise? It is the sound of a dead cat bouncing. The theory of the dead cat is that slamming one down is an eye-catching distraction from other embarrassing problems you'd rather people didn't talk about. In the world of economic growth, these are often controversial or aspirational zombie schemes, like a third runway at Heathrow, or, taking this local, getting Doncaster Sheffield Airport back on the flight path to success. The closed and unprofitable airport, owned by Doncaster City Council, will stay closed unless the council gives it a loan of £105 million, which nets down to an £89.7 million subsidy. Attempts to find a private business to take on the risk haven't come to anything yet, because the likelihood of viability is low. That the airport made £180 million of losses between 2004 and 2022 and never turned a profit suggests how serious the risk is. Coincidentally, the £89.7 million subsidy for a failed airport is just a cigarette paper away from the £90 million that could have secured a significant new AstraZeneca vaccine plant for Merseyside. The £450 million Speak facility would have helped vaccine production in the UK and given the region's bioscience sector a massive boost. They were eventually offered £80 million, but that wasn't enough. AstraZeneca walked. That's it for today. We've explored what illiquidity can do for northern property investment, discovered it's been a good week for dead cats in Doncaster, and await a potentially interesting few years for socially minded pension funds. For more about the built environment in the north, visit placenorth.co.uk. subplot.co.uk. I'm David Tame, and thank you for listening.